All right, guys, welcome back to this class. So last week we got to go over chapter 4, which was all about GAP and understanding every single rule and how it basically formulates everything that we do for this class. So again, that was chapter 4, and we went over a few examples. Today we are diving straight into inventory. All right, we're going to be focusing primarily on periodic inventory, and we're going to be focusing on making our purchases for inventory. Okay, so again, we are focusing on merchandising inventory. So when for the business activity, we are doing merchandising, so we are primarily buying inventory with a purpose to resell it to other people. All right, so in order to calculate how much inventory is going to actually cost us, right, we have to consider all its costs. Okay, and we'll talk about that in a second. So, well, what is inventory? Well, it's the easiest way as part of a merchandising activity is we're trying to purchase items and we're trying to convert cash into goods. Okay, and when we do so, this is us purchasing the inventory, and when we convert those goods into sales. So what happens is those goods become cash. So we're going to be obviously buying them at a little lower cost than what we would normally sell on it, because not only when we when we determine what our selling price is, we want to make sure that we also make a profit. So instead of buying items and selling them at the price that we bought it for and making $0, the whole purpose of, again, the nature of the business is to make sure that we are profiting and making money. That is our main goal. So that is exactly what inventory is meant for when we're dealing with merchandising inventory. All right, so again, how we can be able to do that is we can either stand as a realtor, not a realtor, a retailer or a wholesaler. So we can either sell to our customers at an individual level, or we can sell to our customers in bulk, as in if they purchase a larger amount, we'd be able to give them a discount, but also be able to sell the product to them as a whole. Okay, so what we're dealing with merchandising inventory again. So we want to make sure that if the merchandising inventory includes all costs associated to get the goods ready to get the goods ready, but also to ship to the store. So every single cost to get the goods ready to the store. Okay, so what does that include? So cost of goods sold will include the purchase price that you bought it for. Okay, it's going to include any sales tax. All right, it's also going to include any freight expenses. So what is freight? Freight is another word for shipping. There's also separate charges. There's also separate charges such as shipping and handling fees, as well as if there needs to be storage fees, you have to include that as part of the overall inventory product. Okay, so every single cost to get your product ready and get it shipped to the store. All right. So if you're purchasing it from a wholesaler, generally you may not see sales tax because they might sell it to you without the tax. But nowadays, I believe Costco has gotten rid of that. Thing where you get tax exempt because you're a business. So I believe you have to start paying sales tax now for all the products you buy at Costco. All right, that's just an example of things that you may commonly see where you will not get taxed for products you buy at a wholesale price, right? Now, here's a little something that I want you to understand. Now, this is freight. Okay, so freight costs and how this is determined, all right? It's important that you know who is responsible and what portion of the shipment you are actually paying for. All right. So we have what's called shipping origination or shipping, what do you call it? Shipping destination. And then you have shipping, I'm sorry. You have shipping point, which is, getting the product from the seller's store to your store. All right. That is 100% your responsibility to pay to get those goods from the seller store to the midpoint. Now, once it hits the midpoint and the product is getting shipped to your store, we call that FOB destination. And then from there, that is where the seller is responsible to pay for the shipment. Now, if you think about it, Amazon, right? They want to be good customers and they want to always want to make sure that when they ship the goods out to your store, they are responsible for that product reaching to your house. And again, with customer service with Amazon, if you complain, say I never got my product, they're more likely to be like, okay, what do you want? You want a refund or you want to ship a new product out to you? So again, that would be a perfect example of how FOB destination and FOB shipping point works, okay? So again, if you're paying for shipping, the buyer and or seller needs to match you, so they can pay for the portion to get from the midpoint to your store, okay? Other terminology that I would want you to know is the word FOB. So FOB is freight on board. And then we have another one called COD, which is cash on delivery. So oftentimes you may need to pay for shipping. Like when it arrives, you need to write the check out immediately. Okay, you need to pay for that shipping immediately. All right, so that's what cash on delivery is. Okay, so make sure you understand who is responsible for what. Okay, now we're going to be moving on to inventory tracking methods. Now there are two inventory tracking methods. One is periodic and the other one is perpetual. When we're dealing with periodic inventory, right, the definition of periodic means every once in a while, occasionally. So it's the same thing. It applies through English and it also applies through how we calculate our inventory. This is when we don't really check often. We don't really care if we have whether to keep track of it, right? We only keep track of it is if someone goes down to the basement at the end of the period or any given period that you want to create or establish. So at the end of each period, that is when you go have a physical person go down and count how many items you have available in on hand or in the inventory, the warehouse, the basement, wherever you will put your inventory, okay? And with that, it's going to determine basically then you would know how many items you sold, as well as how many items you originally had. So when you're making periodic inventory, you're obviously going to know how much you're going to order. You have the receipts as well as everything that lists on how much you have. But you won't know how much you will have at the end of the day when you're selling, because you're not going to keep track of how many you sold. You're going to keep track of that at the end when someone goes downstairs and physically takes an account. All right? So when we're dealing with periodic, we're going to be dealing with an expense for the business. Okay? So we're trading an asset. We're going to be paying with cash or whatever that we're doing. If we owe the person, then we owe the person. We put it on account. But no matter where it is, you are going to be creating an expense for the business. Okay? The second one is going to be perpetual. So the definition of perpetual is constantly. And when we are dealing with this constant inventory, what that means is The minute we sell something, we're going to keep track of it. We're going to take it out of inventory as is. So so perpetual is going to be introduced to you a cost of goods sold. So every time you make a sale, you're going to take your inventory items right out of inventory. All right? And one thing that's the difference between periodic and perpetual is, well, two things. One, you're going to be constantly keeping track. You're going to be constantly updating the inventory. So you're going to know how many you have on hand at all times. Second thing is, instead of making it an expense to the business, you are actually purchasing inventory. You're trading an asset for an asset. All right? So understanding the difference between periodic and perpetual. All right? One is an expense and the other is inventory. All right? But for today's chapter, I want to only focus on periodic. When the test is over, that is when we will dive into perpetual. And you're going to see a drastic difference between the two. But yet you'll see similarities. Okay? So when we're dealing with periodic inventory, for example, you're given a scenario. You're going to make a purchase purchase of 100 units of toys, okay? So we're going to be, for this example, we're going to be purchasing toys. Now, as you can read, go ahead and read the scenario. Toys, okay? Which is going to cost you $5.65 each for one toy, right? Freight cost is going to give you a total of $100. Purchase was made on account, so therefore we are going to be owing this person money, okay? So now we need to determine what are we going to be looking at, okay? So we're going to be looking at a few things. We're going to be introduced to a purchase expense and a freight expense, okay? Now again, freight is shipping, all right? It has nothing to do with the original cost of each product. However, when you're selling your items, you want to make sure that you spread across the freight amongst every single item that you sell, okay? So it's important that you know what freight expense is, okay? So let's go ahead and continue our lecture. So when we're dealing with when we're being introduced to a purchase expense and a freight expense, right? And have this scenario. So if each item cost me $5.65 for one toy, and I made a purchase of 100, what is my purchase expense? Okay. So again, let's go ahead and go back to our lecture on how to journalize. What are we going to be journalizing first?
We're going to be putting the toys first.
Okay, now remember, toys, okay, yes, we're going to be putting toys, but there's going to be, because we're not buying the inventory as an asset, what are we doing? What are we going to be making?
A purchase.
We're going to make a purchase. We're going to make a purchase expense. Okay?
Right.
So good. And it's for $5.65 each. Multiply that by 100 and you're going to get $565. Again, what's the next thing that you're also going to put in there?
The cost of the freight.
The freight expense, yes, okay? And why are they debited? Why are they debited? Can you tell me why they're debited?
Because they haven't been credited yet?
No.
They haven't been totaled yet?
What's the hint? What's the hint right there? What?
Expense.
They are expenses. Expenses will always be debited.
Right.
Okay, so good. And then the next thing that we're going to be doing is we're going to be creating a liability. Because we decided to put this on account, what account are we going to be using?
Inventory.
Not inventory.
account payable.
We're going to be using accounts payable because it's a liability, therefore it has a credit balance. So because we're not paying them yet, we're going to owe them the money, right? And then just looking at how much that we look at, they both are equal on each side. All right? So $665 is going to be the total amount that you owe to this vendor, Toys U, okay? So yes, this is exactly what you need to do when you're dealing with periodic inventory. So again, you're creating an expense. All right? So that's it for that one. Okay, does everyone understand? We're going to practice this again when we move on to our exercises. We're going to be practicing this thing over and over and over again. So it's really, yes. So
Yes.
okay? So now I'm going to introduce you to purchase discounts, okay? Well, what is purchase discounts? When you're dealing with a vendor, they're going to give you what's called terms, okay? So what is terms? Terms is going to be if you pay within a certain amount of days, they're going to give you a discount. They're going to reward you with a discount. So if I translate this exact equation here where it says 2% 15 net 30, what does that mean? It means if you pay within 15 days, you can take a 2% discount. If not, you must pay in full within 30 days. Okay? So again, this is usually a special deal that some people might want to do. For example, they when you go purchase an item, they usually say, "Oh, if you make a purchase of $100 or more, we'll give you $5 off." This is the same exact thing, except they're telling you, "Okay, hey, I'll let you owe me money, but if you can pay me back sooner, then I'm going to go ahead and give you a discount for that." So it's definitely a good thing and a bad thing at the same time because, of course, you want to try to get the discount. But again, it may or may not happen when you're in a business because you may have to owe other things and you need to pay them first. So again, it's a good and bad thing, or you could say it's neutral, right? If you miss the discount period, that's okay. You just pay the whole thing off. All right? And usually they don't give you a very high discount. It can range anywhere from 5% would probably be the max, or even 10% would probably be it, because that might cover the tax. Whatever it is that you're looking at, 10 will probably be the most that you will see. So again, this is when a vendor gives you the opportunity to owe them money. However, if you pay within a certain amount of time, they will reward you with a discount. All right? This is very important, especially when we are trying to make purchases for our company to purchase inventory. All right? Okay, so we're going to be introducing you to two methods, okay? So when they give us terms, right? It's either we take advantage of it now or we take advantage of it over later, okay? So the difference between the net method and the gross method is when you're dealing with the net method, you're going to automatically assume that you're very good at paying your bills and you would pay them within the first week, or assuming whatever. You're good at paying bills, you're going to pay on time, you're going to make the payment period. So instead of waiting until the day that you pay, you're just going to go ahead and take the discount right away. All right? Gross method, okay, is going to assume that, you know what, I may or may not pay early. I'm going to wait until when I actually pay to determine whether I take the discount or I don't, or I miss the discount period. So most common practices for businesses is to use the gross method because, again, you may be one of those companies that owe too much to other people that maybe realistically getting that extra discount may not be in your favor because one, you may not have enough cash, okay? Or you don't have enough money in order to pay it off. So you might want to wait a little longer until you have the money in order to pay it off. So that's the difference between the two. When you're dealing with net method, you're taking the discount immediately. When you're dealing with the gross method, you want to take the discount later. Okay? So this is when we're looking into terms. Okay, so let's go ahead and introduce the first one. So the first one we're going to be doing is the gross method. So that means we're going to understand the terms and we're going to take it later. So how do you record this transaction first? First off, let's go ahead and record this purchase. So what are the... Go ahead.
The copy notes. First
Yes.
is the date.
First is the date. All right. What else do you need to recognize? Now, remember, are we dealing with inventory or are we dealing with purchases?
We're doing purchases.
We're doing purchases. So we're going to create a what? What are the two accounts that we need?
Purchase expense.
Purchase expense and freight expense. That's correct. And the key word is it is on account. Right? Yes. Purchase. Yes. So here we have the date, February 1st. All right. We made our purchase expense and our freight expense, right? We understand that the freight was 100 and the purchase was 100 coffee mugs that are worth $1.25 each. So therefore, the total amount that I owe should be $225. Okay? So let's look at scenario one. Okay? So scenario one, I decide that on February 9, I decided that I'm gonna pay Cuppies Co. All right, a check. I'm gonna send them a check for my purchase order. Okay, or for the purchases I just had. So let's go back and determine what was the discount. What was the terms again? The terms were what?
5% within 10 days or full price at
30. Okay. So if I made my purchase of this inventory, right, and they sent it to me on February 1st, if I decide to pay on the 9th, did I fall within the discount period?
yes.
Yes. Yes, you did. All right. So we're going to go ahead and we're going to recognize that we're going to make our payment. However, we're going to take a 5% discount off the entire purchase price. So we have to make so when we send out the check, we write it for 5% less than what is the total amount. Okay? And we're going to be introducing a new account called purchase discounts. Purchase discounts is a contra account. Okay? It is a contra
that's
account.
right, yeah. Okay, so then it flows the other way.
Exactly.
Okay, I get that.
Okay, perfect, right? So again, we calculated what 5% of $225 was, and it was for $6.25. We're going to take that and we're going to subtract it from the $225 that we owe, and we're going to write a check for $218.75. Okay?
Yes.
So do you see how we were able to do that?
Mm-hmm.
All right.
Yes.
Scenario 2 now. What if I decide to pay on the 15th of February?
You don't get a discount.
You do not get to take the discount. We unfortunately missed the discount period. So therefore, what do we have to do?
Here is 10 days.
Yes, but we still paid early, right? We still paid within 30 days. We just paid it, but we just didn't make the
Don't matter.
discount. Okay, so what do we have to pay now?
The full
The full
price.
price.
The full price. So here we're going to indicate the day, the accounts payable, right? Because we owe the money. Now we're paying the money, but we don't get to
Yes.
take a discount. We have to pay the full $225.
Correct.
Okay? So that is gross method for you. Okay? If you pay within the discount period, you can go ahead and take the discount and you're just introducing a contra account called purchase discounts. But if you miss the payment period, then you're just going to have to pay for whatever you owe. All right?
Yes.
Any questions about purchases and this purchase discount? Especially dealing with our gross method. Okay?
No.
All right.
No.
Now we're going to be introducing the net method. So now we're going to be looking at this in a different perspective now. So again, what does net method mean?
Net is
Well, you
right now.
for the discount
Right now.
immediately.
Exactly. You're going to take the discount immediately. So let's look at our problem again. So it's the same exact scenario. It's the same exact problem. So we're dealing with purchasing 100 toys at $1.25. And we're dealing with, again, $100 of freight. And it's going to be on account. So how do we determine what accounts we're going to be using?
Purchase expense
Mm-hmm.
and the freight
Mm-hmm.
expense.
Purchase expense and freight expense. And we're putting on account. Now, I'm going to ask you a question. Can you take a discount off of the freight?
No.
No.
Freight or you can't do shipping, freight, or sales tax.
Exactly. So therefore, where are you taking the discount from?
Items.
Yes, you're going to take it off of the original purchase price. So again, we're dealing here. We calculated at the bottom here, right? 100 times $1.25 gets you 125. Then you're going to multiply that by the 5% discount, which is $6.25, which you're going to take that right off of the $125. And you're going to get 118.75 for just the purchase expense, okay? And here for the freight expense. So therefore, in total, you owe $218.75, okay? Now, again, scenario 1, you are going to pay on the 9th of February. So did you make the discount period? Did you make the discount period?
Yes.
Yes.
Within 10 days.
Yes. You paid within the first 10 days, exactly. So how are you going to record this now?
Accounts payable,
Mm-hmm.
Payable.
the 218.
Yep.
Where's your chart?
No, that's right. That's
I'm
right.
waiting for the chart to come back up. Yeah, the 218.75, and then
Yes.
checking account.
Yes.
um,
We-
and
all right.
credited, the same amount.
Good. Now, because we've already took the discount, right? So we're just going to pay the straight away with a discount number. All right? So good. We don't have to create another entry establishing the discount because we've already taken it out. We already made the assumption I'm going to pay early. I'm going to make this discount. So that's all you need to pay because you've already taken the discount out. All right? So yes, it's going to be accounts payable for the 218 instead of the 225. Now, what happens in scenario 2 when, oh, I missed the discount period? I end up paying on the 15th instead of the 10th, right? Because the 10th would have been the discount period. So what happens if I end up paying after the discount period?
Full price.
Yes.
But don't you have to itemize it?
What do you mean by that?
The discount amount in a separate line.
Yes, you're going to have the discount amount. However, because we failed to make the discount, we're going to have to recognize a loss.
Right, so that has to go under, debit.
Yes, it's going to go under debit. Good.
Okay, so, the 218.75 would be the accounts payable,
Mm-hmm.
and then the $6, whatever it was,
Mm-hmm.
also under debit.
Mm-hmm.
So both under debit.
Okay. And then we're going,
Yeah.
good. So we're going to recognize another account. It's going to be purchase discount loss.
Oh.
Mm-hmm.
It's,
Okay. So again, because the first scenario, right? We knew we were going to pay early. We knew we were going to be good at it. But this time, this is just in case, oh, I am using the net method and I forgot to pay. Then I have to recognize that I actually lost that discount. I don't get to take that discount anymore. So instead of reversing the transaction, what's going to happen is you're just going to end up paying more. So here, instead of paying $218, now I got to pay an additional $6.25 because I missed the pay period. All right, and I recognized the loss. So again, this is a form of a contra account. It's going to be a contra account to the purchase discount. So it's a contra of a contra. So not to be too confused, okay? Yes, it flows in the same way as purchase, but remember, this is a contra of another contra account. If purchase discounts was a credit, therefore the contra of a contra is going to be the opposite flow, which is a debit. So again, yes. So that's how you deal with when you're making a purchase and a vendor gives you the freedom to be able to owe them on an account. You just have to remember which method would work best for you. And in a small business standpoint, your best bet is to use gross method just to be safe than sorry. Okay? And then here's chapter 5 review. So again, we recognized what inventory is, and the cost of inventory is going to be including every single thing to get the items to your store, right? Another thing that we want to recognize is the tracking methods. So we got periodic inventory and perpetual. Periodic meaning every once in a while, and that you have to take a physical count at the end of the period. Okay, so think of end of the period, periodic, right? And one thing you have to remember, periodic is dealing with expenses. Perpetual means constantly, so you're going to be constantly updating your inventory. So you're going to keep track of how much you sold and how much you purchased. So therefore, you're going to know how much you're going to have at the end of the day. All right? And then next on the right side of the screen is understanding FOB origination or FOB shipping point. Just understand that it's the seller's. So if you're at the seller's store, right, and it's shipping to the midpoint, the buyer is responsible to pay the shipping there. From the midpoint to the buyer's store, it's going to be the seller's responsibility, which is called destination, FOB destination. Okay? Understanding key terminology such as freight on board and cash on delivery. And then lastly, how to journalize purchase expense using the periodic tracking method, right? You're going to be recognizing two things, purchase expense and freight expense. And if it's on account, then you put accounts payable. If not, you put cash. All right?
Okay.
Any questions on chapters 2.1. Okay, this is the difference between net method and gross method. Okay, all right, understanding net means you're going to take the discount immediately, where gross you're going to wait till you actually start to pay to take the discount. All right,
Okay.
any questions on chapter 5?
No.
All right.